Kinder Morgan. What else is there to say? Dan Dicker is here. He's our real money contributor, oil expert. And Dan, what are you going to say about this
Well,
one?
the first thing, I broke one of the cardinal rules of trading, and that is trying to catch a falling knife. All the fundamentals in the world don't mean a thing, and this is a learning experience for me personally, because I've lost a lot of money on this trade, but also for people out there. You don't do that no matter what the fundamentals tell you. And I could make a tremendous case for buying Kinder where I bought it, and I did. But the bottom line is that when a panic sale is in the works, you really don't try and catch a falling knife, and that was a big mistake. So.
But it's also perfectly understandable when you look at the fundamentals about this company.
Yeah.
This is a giant pipeline company that's been around forever.
Right, and the upshot of what's gone on in the last week is twofold. One is that Kinder was forced to, in some ways, abandon the whole structure that they kind of invented by this taking on a 75% dividend cut, which nobody expected and I thought was way over the top. So it changes them from what was this kind of MLP structured, accessing the credit and the equity markets to finance further growth kind of deal into some sort of growth utility stock at this point. And I don't know what that really means and how to analyze it, at least right now. The second point that I have to make is that because the stock is up significantly today after that dividend cut, kind of proves to me that this has been a big bear raid over the last several sessions. The shorts have been really piling into this and unnecessarily so. So that to me, when markets like this and with a 75% dividend cut and seeing Kinder open up, close to $1 higher, that's a lot of shorts covering.
So then, I hate to ask you, but of course I have to ask you, is it a buying opportunity now?
No, in fact, it's the other way around. It's very hard for me to value it, and to me, that the shorts are caught. And I hope that they're caught for a lot of money because they've caused a lot of pain over the course of the last week. But I still want to take that opportunity of the shorts covering here to cut losses on the shares. I did it for my own accounts this morning, close to $17. In the end, it won't be that big of a loss. From 21 to 17 is not an insignificant drop, but I've had a lot worse. It's happened in such a quick time, and the interest in Kinder Morgan got so large so quickly that it seems a lot worse than it actually was. It was just another trade, and it's a very, very bad one. And I'm sorry for those that followed, but bad trades are also part of what I do.
This has been a stock that's captured a lot of investor interest, and we've had a lot of ink here at TheStreet.com, although it's not really ink anymore.
Right.
But I have to ask you as well, can we talk about anything beyond Kinder Morgan? Is it best just to back out of the space for now or hold positions currently?
In fact, and maybe nobody wants to take my judgment on the space at this point, considering, the bad call I had in the last week. I think that Kinder's move, in fact, spells an end to the MLP space. They were the mothership of MLPs, and with a huge dividend cut, they've in essence abandoned that structure. Now, will all the other MLPs be forced to follow? I'm not sure about that, but they're certainly going to have a lot of pressure in abandoning to a certain degree these very large distributions that they have planned for the next year. And I think that bodes well for the space in its entirety, which in fact, except for trying to catch this stock, I've been saying for the last 8-9 months to stay away from the space. This move by Kinder, I think, makes the space, if it could possibly be worse, even worse.
Dan Dicker, that's where we ended. Thanks so much. I'm Rhonda Schaffler for The Street.